The unfortunate disaster engulfing Los Angeles is bad enough, but the situation will get worse with what happens next.
The insurance companies are going to do everything they can to lowball and deny claims.
Insurance is like having a big bouncer looking dude as a friend who is also scared to get hit. He makes you feel like you're protected if you were to get in a fight, but he'll just run at the first sign of a problem.
California is the only state that does not allow private insurance companies to incorporate the cost of reinsurance into their premiums. And this is why 100,000 Californians lost coverage between 2019 and 2024.
Instead of losing bad politicians, many Californians unfortunately are about to find out that they lost insurance, especially the kind that covers fire damage. 3/4 of homeowners may not have enough insurance to fully cover losses after a disaster, study says. I'm considering this situation to be a massive scam because I believe that many California homeowners are about to find out that they have been misled, screwed over, or lied to regarding the protection of their home. AccuWeather has updated and increased its preliminary estimate of the total damage and economic loss to be between $135 billion and $150 billion. Thankfully, we'll just need to ask Ukraine for our money back to cover this deficit, so there's nothing to worry about. A whopping 69% of homeowners in Pacific Palisades lost their homeowners insurance before the fire. Pacific Palisades led the list where about 1,600 policies were dropped by State Farm in July. Many insurance companies saw this from a mile away. What may seem like a bit of a black swan event was actually predictable given the policies implemented by the most intelligent politicians this world has ever seen. Remember, these decisions were made before ChatGPT, so we can't fault them that much.
Mr. Rosenfield, what is the mood of the people out there in California right now?
Angry. We're fed up with 3 years of high insurance rates.
In 1988, California voters approved a ballot measure backed by consumer groups, read tort lawyers, that turned the insurance commissioner into a rate-setting czar.
People are angry, and that's why we put Proposition 103 on the ballot.
Harvey Rosenfield, David to the insurance industry's Goliath.
This Proposition 103 law was intended to protect consumers by limiting how much insurance companies could charge consumers. Policies in California can generally be nicknamed jacking off because they may feel good in the moment, but after a while, you're just screwing yourself.
The impact that Prop 103 has had in this state.
Yeah, let me tell you, it saved billions and billions and billions.
The savings to people of California just for auto insurance has been over $150 billion.
Contrary to claims that Prop 103 saved Californians as much as $154 billion in auto insurance premiums from 1989 to 2015, we find that Californians would have saved nearly $25 billion if they had not passed Prop 103. Because of this legislation, insurance companies couldn't update policies to adequately offset the risks associated with California's potential wildfires. One major lesson I learned from reading Nassim Taleb's books is how poorly equipped humans are at understanding risk in black swan events. This legislation helped consumers save a few bucks each month for a while, but what happens when the black swan event eventually hits? Californians are now living with the outcome. This now prophetic blog post was written by Stephen Greenhut in 2023. Now, as the state budget looks at a $23 billion deficit, California confronts a new challenge. A serious crisis in the insurance industry is looming, largely unnoticed by state officials. Hate on insurance companies all you want, but their business is only kept alive because of their predictive software and forecasting. If they're leaving your city, the one excuse you don't have is, I had no idea this catastrophe was coming.
These families in a suburb like this are not alone. At least 7 of the state's property insurers, including big companies like State Farm and Allstate, have either left the state of California or are only offering limited coverage.
The recent floods and wildfire season not only have battered the state's infrastructure, they have also saddled insurance firms with as much as $1.5 billion in losses. Insurance markets could weather these blows, but the government-controlled insurance system won't let them.
And those throughout the state that are also suffering the risks of losing and being priced out of fire insurance as fire risks become more severe and more pertinent.
According to the California Department of Insurance, between 2020 and 2022, insurance companies declined to renew 2.8 million homeowner policies in the state. That includes 531,000 in fire-ravaged LA County.
If you have a mortgage, the lender will force you to have insurance, so what's your next best option? Thus, insurance companies are pulling out of the state or reducing their underwriting, leaving many homeowners dependent on the bare-bones insurer of last resort, the state-created Fair Access to Insurance Requirements Plan.
In 2019, just under 160,000 people were on Fair Plan residential and commercial policies. In June of this year, that number stood at nearly 420,000.
Many Californians were probably relieved that the state jumped in and gave them the feeling of protection. This will become a scam if these homeowners aren't able to get the funding they need to rebuild their home. But in March, FAIR Plan President Victoria Roach testified that the plan was dangerously overextended, accountable for more than $300 billion in potential losses, with just $200 million in surplus available to cover those costs. This next clip was filmed February 8, 2024, and will provide some insight into what's going to get worse for California homeowners.
A lot of people with damage to their homes from this week's storms are trying to decide if it's worth it to submit a claim and potentially jeopardize their policies. The I-Team has been reporting how more and more homeowners are being dropped by their insurance companies. And this is when the state's FAIR Plan is supposed to kick in and help out. But the I-Team learned homeowners are now struggling to secure that coverage, too.
The companies that California kicked out have the funding necessary to handle large-scale catastrophes. It doesn't seem like FAIR has the funding. Meanwhile, the value of the residential properties insured by FAIR has risen to more than $450 billion, triple what it was in 2020. This has led to worries that with all the damage from the current fires, the plan will go broke. In the same video released on February 8, 2024, it appears that FAIR was already known to be in trouble.
The volume of applications that they're getting is swamping them.
Amy Bach with the consumer advocacy group United Policy Holders says the FAIR Plan can't keep up with demand.
A full year later, here's an updated number on FAIR's financial resources.
That FAIR program only has $700 million cash on hand to pay claims. All right. California is the only state that does not allow private insurance companies, State Farm and Allstate are the two biggest in California, to incorporate the cost of reinsurance into their premiums. And this is why 100,000 Californians lost coverage between 2019 and 2024.
One of the unfortunate realities of this catastrophe is that many homeowners are going to be screwed because of legalese in an insurance policy they didn't fully read, understand, or put much thought into. Hurricane Katrina hit New Orleans in August 2005 and cost an estimated $125 billion in damages. Homeowners sue insurers for denied Katrina claims. Hundreds of homeowners along the Gulf Coast are suing insurance companies for refusing to pay for damage that their waterfront properties sustained from Hurricane Katrina. In denying their claims, insurers cited the language of the policies, but attorneys for homeowners argue that many of these claims were improperly denied.
The people who built their houses to spec, who paid their federal flood insurance policy, had a homeowner's policy because in hurricane country you don't know whether it's going to be the wind or the water that gets you. So you hedge your bets with both. And like thousands of other people in the weeks after the storm, one after another, were told by their private insurers, we're not going to pay you.
I bring up Katrina, even though it was a long time ago, because I think there will be similarities between that horrendous catastrophe and the one we're seeing right now with the Los Angeles wildfires. The major issue in both situations is insurance payouts to protect those who have been victimized. Since certain areas of New Orleans weren't listed as flood zones, thousands of people didn't have flood insurance when Katrina struck. This left them with no insurance coverage for flood damage, which can be the costliest of repairs. And it was impossible to access most homes in the days that followed, making homeowners too late to prevent mold growth in buildings and significant damage to personal possessions. Those without flood insurance had no option but to pay out of pocket or abandon their properties because they were uninhabitable without extensive repairs or rebuilding.
About 10 months before their policy renewal, Gerardo received this letter from AmGuard saying they are no longer writing policies in California. AmGuard says policies were canceled in 2024 because they no longer rate any insured policies in California due to wildfire risk.
My concern is that some insurers are going to be able to weasel out of paying damages due to wording in people's policies without them knowing that they weren't covered for wildfires. Court, insurers not liable for Katrina flood damages. I have a sneaky suspicion that we'll be seeing similar news stories in the following months about insurers not liable for LA wildfire damages. Best of luck to everyone affected. Thanks for watching.